You've just been accepted onto an income protection claim and your payments have just started.
Use it well.
Hi, I'm Phil. Welcome to Skye Simplifies, and today I'm going to be talking about some of the things to consider now you're on income protection claim. So just like with all claims, the things to consider really does depend on the benefit amount that you're receiving. So the average claim amount through superannuation is $4,000 per month, and the average claim if you set up the policy with a financial advisor is $8,000 a month, but it really does depend on your individual income at the time of claim. So some of the things to think about is, number one, income protection is taxed. So those benefit amounts of $4,000 or $8,000 a month is pre-tax benefit amounts. So the insurance company will be deducting tax out of their payments. The second thing to think about is income protection, unlike some of the other insurance policies that we set up, is not a set and forget from yourself or the insurers or the advisor's point of view. So insurance companies have the right to get ongoing medical evidence. So you may be on claim for a month, 2 months, 3 months, or you may be on claim until age 65. And so there will be an obligation to continue to provide medical evidence that a doctor has recommended that you not be at work. And there may be some financial evidence as well. Some income protection policies have what's called partial benefits. So you can work maybe 1 or 2 days a week. The income protection provider will provide the difference between your benefit amount and your actual income. So we may need to be providing ongoing financial evidence just to show what that gap is. And the third thing to consider is your benefit period. So some income protection policies, and the ones we like to set up, last until age 65. So if you're on a long-term claim, you'll get paid every month until age 65. A lot of the super funds will have policies for only 2 years. So if you are totally and permanently disabled and you're on income protection claim as well, then you've got to plan out for those first 2 years while you receive that money. But then after that, that income protection policy will stop. So it's really important to start planning as early as possible if you do believe you're going to be on claim for a long time, because the income protection policy will stop after 2 years. Now, the other things to consider is some of the misconceptions around income protection. So once you are on claim and then you go back to work and you're off claim, your premiums will not increase. So the insurance provider won't charge you a higher premium just because you've claimed on it. It's not like car insurance where you crash your car 5 times and the premiums go up. Income protection premiums are the same whether you've claimed on it or whether you haven't. And then the other thing is, if you are on a short-term claim, so you're out of work for 3 months and then you're back at work, once you're on claim, you don't pay any premiums. But then once you're off claim, then your premiums will kick in again. So when it comes to income protection, you're either paying money to the insurer or you're getting money from the insurer.